JPMorgan ditches student loans. Americans are having babies again. And we're going to answer your questions. You're in the right place because this is where the money is. I'm Alison Southwick, joined today by Matt Koppenheffer. David Hansen is out, so for all you fans, sorry. Today we're going to answer some of your questions. We're going to play a little investing chicken, but first up, as always, the headlines. So good news on the job front. As the Chicago Tribune and others reported today, the U.S. jobless rate dipped to 7.3%, and the economy created 169,000 jobs. So Matt, were there any surprises to you in this report?
Surprises, I don't know. I like to look at some of the things that maybe other people aren't looking at just to add a little bit more color to the picture. The average weekly hours worked, that was flat from last month. That's something that I like to look at because as that starts to creep up, employers end up having to hire more people. So that was flat. That doesn't help too much. The manufacturing overtime hours actually have been climbing month over month for a few months now, and that's a little bit of a good sign. But as much as I like to be an optimist, I have to highlight a couple of the things that I'm not particularly happy about in this jobs report. One of the big ones was that the past jobs numbers were revised down in a big way. So for July, 188,000 jobs added was the original, what was announced originally. That was revised down to 172,000. In June, 162,000 to 104,000.
Wow.
Between the two, 74,000 jobs were removed from what we thought we had. The other was, and this is an ongoing thing, it's the long-term unemployed. That's the unemployed who have been unemployed for 27 weeks or more. That stands at 4.29 million. That actually ticked up slightly month over month. Year over year, it's down. But this is the most concerning group of the unemployed because when you think about people who have been unemployed that long, you start to lose skills, you start to get left behind by the economy and what's happening. And those workers increasingly, it's exponential growth in how hard it becomes for them to find a job. So that's worrisome. I'd like to see that number in particular come down more.
All right, next up. Reuters is reporting that JPMorgan is getting out of the student loan business because of competition from the government and then regulatory scrutiny. So, Matt, is this a good idea that they are just getting out of this?
Yes.
All right.
So two things to point out here. The first is on the regulatory front. In the Reuters article, it said that JPMorgan is not making more loans. Puts us, that's JPMorgan, in a position to redeploy those resources as well as focus on the number one priority, which is getting the regulatory control environment strengthened. That is obviously a big deal. JPMorgan's been in the headlines so much, they want to avoid any more of that. And student loans in particular, I think, is a great way with everybody focused on how expensive college is, how much trouble students are getting into with hundreds of thousands of dollars of student loans. I think for JPMorgan, and that brings me to my point number two, that student lending is not a very big part of their business. It's the Reuters article said it was less than 0.5% of JPMorgan's total assets, the student loans were. So it's not a big deal for them, and to avoid any trouble, any more bad headlines that they could get out of this, I think it's a good idea. David and I were talking about Discover Financial Services yesterday, who has been growing its student loan business, and that's one of the things that concerns me about Discover, although I'm bullish overall on Discover. I think there's trouble. I don't know. I just think there's bad headlines. There's regulatory risk ahead for anybody making student loans. I'd like to be proven wrong, but that's where I'm at.
All right, finally. The Wall Street Journal is reporting that at least 3 Democrats on the Senate Banking Committee are expected to vote against Larry Summers if he gets the nomination for Fed chairman. So, Matt, how do you feel about this?
Regular viewers of the show know that I'm a big fan of Janet Yellen. I think Janet Yellen would do a great job at the Fed. I think she would build consensus in much the same way that Ben Bernanke has. I don't understand the obsession with getting Larry Summers in there. We can't get Congress to agree on anything. So why try to bring in somebody as Fed chair, which is supposed to be a non-political position? Why bring in somebody as Fed chair that's just going to explode into an eruption of disagreement on Congress? I hate the idea. Great, Larry Summers, smart guy. Get him somewhere else where he could help out. Janet Yellen for Fed chair. That's my vote.
Time to make some posters and buttons
listen to
for
me,
you to
Barack
wear.
Obama. Janet Yellen is the right pick.
All right. All right. Well, that's it for the headlines. Now it's time for our deep dive today. And today we're actually going to go to the mailbag. So we asked our fans, friends, fools on Twitter, what would you like to ask? And we heard back from Michael Ann Harvey. Her question is, what do you say to the doom and gloomers who predict total economic collapse in 2013? So that's your question.
Well, I say first of all that the data doesn't support any of that. But those predicting total economic collapse don't want to hear that and don't hear that because they say that the numbers have been manipulated and that the numbers don't show the reality, and so they don't believe it. The other thing is that reality doesn't support it. I mean, you go outside, you go to the mall, go to stores. People are shopping, people are working. Sure, unemployment is higher than we'd like it to be. Employment growth is slower than we'd like it to be. Economic growth is slower than we'd like it to be. But people are creating value through making things. And they are out spending money. They're feeding themselves. They're feeding their families. They're buying houses because they need places to live. The economy is functioning. So I don't get the whole economic collapse thing. I think it's completely wrong and misguided. But we'll talk a little bit more about psychology and behavioral effects later when we get to the Twitter sphere. But one of the key behavioral issues that investors run into a lot is the framing effect, and that's or recency bias, I guess probably is more what I'm thinking about here. Thinking back to the most recent example of something and then pushing that forward and letting that dominate your view of everything that's going to happen.
It's like this now, it's always going to be like this.
Exactly. So 2008, 2009 was terrible. We had a lot of people saying that we were on the verge of economic collapse then, so they're just projecting that forward. And you've got this belief in this wise pessimism kind of thing now. And I think it's wrong, and I think it's going to persist until it doesn't, basically. So it's going to be proven wrong long enough that people are finally, it's like a dripping water, finally convinced otherwise. So I'd say worse than the fact that I just think the position is wrong, what the believers in this have been gravitating toward is gold. And as of late, as of, say, the past year or so, investing in gold just hasn't worked out very well. And along with that, the big proponents of gold have been starting to finally relent and say, okay, we're going to get out of this. We just saw last month John Paulson, who runs the giant Paulson Fund and was a big gold bull, cut his position in the gold spider fund by more than half. So he's realizing that that's not working out. I think a lot of other people are realizing that that's not working out and that the economy is recovering and there's no reason to be in gold. So what do you do instead? What do you do instead of listening to this economic pessimism, the economic collapse kind of theme? I say it's investing in great companies. That's probably not too surprising. In the financial sector, Wells Fargo, look back to the economic crisis. Look at Wells Fargo's performance. Look at Wells Fargo's performance through 1990 and 1991. That's actually the era when Warren Buffett first invested in Wells Fargo for Berkshire Hathaway, because even though there was a lot of concern about what was going to happen to Wells Fargo performed well through that banking crisis, performed well through this banking crisis. So if we had total economic collapse, I don't think you'd want to be invested in Wells Fargo. But through what I think is reasonable to expect that we could see in any and all circumstances, Wells Fargo would be a good one. Berkshire Hathaway, great diversified business, a lot of strong businesses there. I know I go on and on about Buffett and Berkshire. And then finally, one smaller one, if you're looking for an undercover pick, Portfolio Recovery Associates. This is sort of a play on the idea of bad economic times or tough times for people. They buy charged off credit card and other loans and portfolios, and then they collect on those. So they buy them for pennies on the dollar. They collect a few more pennies than they bought them for, and they do very well. They are very good at that business. And the previous recession was actually very good for them because they can buy more of that on a cheaper basis. I think that stock is maybe a little bit expensive right now, but I think the company is so good that it's worth keeping on your radar.
All right, so bottom line advice.
Ditch the drastic the belief in the drastic pessimism forecasts.
Yeah, and I think you also need to question those people who are always predicting total economic collapse. How are they trying to make money off of that prediction?
Absolutely.
They might be trying to convince you to buy something that benefits them. So, all right, enough of that deep dive. Now it's time for a little investing chicken. For those who aren't familiar with investing chicken, this is where we take a stock that we are bullish on, and then I'm going to try and talk Matt out of it by raising the stakes and see when he turns chicken on this.
All right.
So the company we were looking at today is Huntington Bank Shares. This is a stock that you are bullish on.
It is.
And so the first one, the first scenario I'm going to throw at you here and see if it scares you enough to sell or to turn bear here is if there was an average economic downturn. We just talked about total collapse, but average economic downturn.
So this wouldn't be a reason for me to sell. The banking industry is a cyclical one, so Huntington would probably not do great during an average economic downturn. But the reason that I like it is I think it's a well-run bank, so I think it'd do fine through an average economic downturn.
All right. That's fair. The next one, if the bank made a large acquisition.
So this would depend a little bit on the details of the acquisition. But and right now it's kind of a tough environment to be making acquisitions. Deposit bases aren't as valuable as they usually are because interest rates are so low because you can't lend out the deposits for as high of a rate as you usually can. And the prices that you could make an acquisition for aren't as cheap as they were. However, I trust management here, so as long as they get a decent price and it looks like a pretty well-run bank or a real steal that they're getting, I'm okay with that.
All right, what if they backed away from asterisk free checking and 24-hour grace? Maybe outline those policies a little bit.
So asterisk free checking is, we've seen a lot of banks backing away from free checking because it can be unprofitable for them. And we've also heard a lot of customers complain about overdraft fees and that sort of thing. That's nothing new, but that's a long time thing. So Huntington has this asterisk free checking, which is basically free checking, no strings attached, no asterisks, nothing else. And they also have this 24-hour grace program where if you overdraft your account, you have 24 hours to get funds in there to cover it, and if you do that, you don't get hit with a fee. If they backed away from these, I would start to worry a little bit because one of the reasons that I like Huntington as a business is that while a lot of people are complaining about banks not really being in tune to their customers, working in their customers' best interest, I think that programs like these show that Huntington is trying to be different. And I think that gives them a differentiating advantage versus other banks. So I would get concerned. I don't know if I'd sell at that point, but I'd be getting a little concerned there.
All right, I've got two more.
Okay.
All right, what if they went on a branch building binge?
Similar to the last one, I would be getting concerned. I would have to hear some really good strategic rationale for it. So okay if they continue building branches. But one of the things they've done is they've created deals with grocery stores to do in-store branches. So I don't consider that a full banking branch. It's lower cost. It's more convenient for customers. I like that strategy. And then also just in general across the banking industry, increased use of online banking, increased use of mobile banking, and so I think that's more of a driver than the branches. So I don't like the idea of thinking about them having a ton of new branches.
All right. I think I'm going to get you with this one. We'll see. If the CEO, Steven Steinauer, left.
I could, so let's say we combined these three last ones. No more asterisk free checking, no more 24-hour grace, big branch building binge, and Steiner leaves. And maybe even if he leaves and then those two happen, I think I'm going to be selling at that point because Steiner is such a good leader. I think is a really good banker and has done great things at Huntington. And I think he has a lot more to do, and I think he plans to do a lot more. So I wouldn't want to see him leave, and I think that would change the thesis behind Huntington considerably.
We do like good management here at the Motley Fool.
Yes, absolutely.
We love our good CEOs. All right, well, I don't know if I can count that a win for me, but it was pretty close.
I'm a chicken on management. As we play this game more, usually what ends up knocking me out is when I'm confronted with a management team that I like and them leaving for unexplained reasons. That'll often have me running, doing the
I'll remember
chicken dance.
All right, now it's off to the Twitters. As always, we like to end our show with seeing what everyone else is talking about. So we are starting off today. We did a little eavesdropping today on a conversation Paul LaMonica had with Faisal Al-Mansour. And the tweet is at LaMonica Buzz, should we hope for weaker economic data so the market maintains its rally? Hashtag weird market. So Matt, is it really that weird of a market? Should we be hoping for weak economic data so the market keeps going up?
It is a weird market, and we can see that just in the fact that anybody would even think to ask a question like that. When would you not want better economic data? And I think this question gets to the difference between sort of thinking about your investments in terms of a stock versus in terms of a company. Because when you think about it in terms of a stock, then you can get into like, oh, I really like this rally. This rally is great. The stock price is going up. You know, investors who think about it in terms of a company don't care about that because they want to see the company perform well and do well over the long term. And so they'd much rather see better economic numbers, better economic production, because that's going to be good for the profits of that company. I think a similar question would be, say if we turn to Wells Fargo, they've gotten so much income from refinancing, from mortgage refinancing, because interest rates have been so low. But on the other hand, the spreads that they've earned on their loans have been so low because of low interest rates. So it's a similar question to say, do we want to see interest rates stay low so they can continue to churn out these refis? And the same answer is true. We would want to see from the banks, from Wells Fargo in this instance, perform well over the long term. And it's a much bigger deal to get that spread income than to continue to juice a unsustainable refinance boom.
All right, next up. At Reform Broker, downtown Josh Brown. After 5 years of economy-related birth rate declines, the U.S. is finally making babies again. Thank you, Robin Thicke.
It's all about Robin.
Music.
We can't get away from Robin Thicke these days.
Baby making music there. So when the U.S. is making babies, does that make you happy?
It does, yeah. You know, if you think about long-term economic growth, you kind of put together the factors. The factors are you've got labor, you've got capital, you've got technology, and if your population isn't expanding, if you've got an aging population, I mean, we look to Japan. A lot of people are very concerned about what's happening in Japan because the population is aging so fast. You've got a lot of people who are going into non-working age. And when you have any sort of social programs, I mean, people seem to think in some cases that the social programs in the U.S. are overwhelming. In other countries, it's much different. But you have non-working populations supported by the younger working populations. When that gets out of whack, it's no good. And the economy doesn't expand well. For whatever kind of business you're investing in, I think you want to see labor expanding, you want to see the country growing, so I think that's a good thing.
All right, maybe we need
whether or not it has to do with Robin Thicke.
I don't know, I was going to say, maybe we need like a Robin Thicke index. When he like makes a new sexy song, we're going to watch the economy continue to grow.
Can we get somebody else? Can it be somebody else? It is a catchy song.
All right, last one, we've got Dan Ariely. On attention as a limited resource and on the effects of not having sufficient food or money. And he links to a New York books.com article. So Matt, what's this about?
So it's a behavioral thing here. This is Dan Ariely's specialty. One of the things from this book, it's an article about the book, but that jumped out at me is that they were looking at what happens when you are when you are restricted from something and what that does to your focus. So they were talking about, this is a really terrible experiment, but it shows what we're talking about here. After World War II, the Allies were trying to figure out how to best start feeding people who were hungry. So they took a group of healthy people and they put them on a calorie-depleted diet and watched what happened to their mental functions. And they became totally fixated on food. All they wanted to do was read menus, read cookbooks, talk about becoming farmers and restaurant owners and all this. They became totally fixated on food. And so the idea here is that when you feel restricted from something, and it doesn't have to be an actual restriction, you don't have to actually be depleted of something, it can be just a psychological restriction. So I think about in our country where a lot of people are living what would be considered very comfortably in many other countries, and yet they look at everybody else who's got the yachts, the private jets. You watch Robin Thicke, and all of bling and everything, and they feel like they're restricted from money. And then it becomes this focus on money, and it makes people, the bottom line is it makes people stupid. And so relating this to investing, I think that when we become, feel like we're restricted from money, and we're investing in that way, I think that can really hurt investing results. But backing away from investing, what do you feel like you're restricted from in your life? What resource do you feel like you're most needing in your life?
Time.
Time.
I need more hours in the day. Yeah, absolutely.
Do you become fixated on that?
I do.
Do you feel like you need a time machine or like a time stretching device?
I actually bought a Fitbit.
Okay.
Not to do like a plug here, but I did buy a Fitbit.
You can get them on Amazon.
Right. And it tracks my sleep. So I actually I bought this right around when we had my baby, and I was curious about really how much sleep am I getting as opposed to work and all this stuff, and how much exercise, and am I getting enough? And so this tracks all of it.
Right.
And so yes, I've been fixated on how much time do I spend exercising, how much time do I spend sleeping, and then also at work I'm just constantly running around. So.
Yes. I would actually probably go with the same thing. I have something similar. I have an app on my iPhone that tracks my sleep. It's kind of depressing sometimes.
Yeah.
But yeah, at least it's not money. Or though, time is money, right?
Time is money.
It all comes back.
It does come back. Well, I think that covers us for here today and for the week, but I actually would like to hear from our viewers on what they feel is a limited resource in their life. So feel free to let us know in the comments below, and thanks for watching. We will see you on Monday.